Good morning, everyone. A bit of a cold one this morning, but welcome everyone to BDO's webinar providing an Irish tax update for professional services firms. People that don't know me, I am Louis Keeping. I'm a tax director in the London Professional Services Team. I've organised the webinar programme which provides topical presentations aimed at the professional services sector since it began about eight or 9 years ago now. I advise on a broad range of partnership structures for professional services firms with a particular focus on international law firms, architects and consultants. And I've specialised in this sector for over 15 years now, actually. So I've got a portfolio of UK and international based professional services clients. And my experience really is undertaking advisory and structuring work for my clients, as well as partnership and partners tax compliance and tax reserve matters. So for those of you who don't already know, BDO is a global accounting network with over $11 billion in revenue, where we provide audit, accounting and tax services in 164 countries with over 110,000 people. So our session today is to provide you with an update on Irish tax. We've certainly seen a lot of activity with UK firms setting up in Ireland post-Brexit, and this continues to be the case. We've helped a number of firms in recent years create a presence in Ireland. Our speakers today are Eddie Doyle and Mark Hines. Eddie Doyle is a senior consultant from BDO Dublin, and he has significant experience assisting firms in the professional services sector. And myself and Eddie have worked together on a number of clients over the years. Mark Hines is head of employment tax at BDO Dublin and advises on global mobility, domestic employment tax, and employee and executive share plans. So today we're going to be covering a range of subjects, looking at an overview of the Irish tax system for inbound professional services firms, structuring options, as well as an update on payroll tax issues covering secondments. Please do ask any questions during the webinar using the Q&A feature, which should be at the top of your screen. We will pick up as many of those questions as we can during the webinar. If time does not permit, we will pick them up after the session and we'll come back to you. We are recording this webinar and we'll email you the slide deck as well as a link to the recording in a few days. Right, so I will now hand over to Eddie. Over to you.
Okay. Thanks very much, Louis. Good morning, everybody, from, I won't say sunny Dublin, it's rainy Dublin, not surprisingly. So I'm going to cover, so if you want to just click up, so if you go back to the agenda, Jade, if you wouldn't mind. Okay, so what we're going to cover this morning, obviously Louis has kindly done the intro. So just first of all, just a brief overview of the Irish tax system, tax rates, etc. Then moving on to, I suppose, more specifics in terms of structure options for UK firms setting up here in Ireland, and the various tax treatments then for those different kinds of structures. I'm then going to hand over to my colleague Mark Hines, and he's going to take you through the payroll issues, including secondments and cross-border movements and everything else. And as Louis said, then we're more than happy to take questions at the end of the presentation. So thanks, Jade. Okay, great. For more, thanks very much. Okay, well, first of all, just I suppose the basics in terms of the tax situation here in Ireland and an overview. We have, I suppose, first of all, for income tax for individuals, there are two rates of tax here. There's a 20%, what's called a standard rate, and then there's a marginal rate of 40%. Go into the 40% rate pretty quickly here in Ireland, certainly compared to the UK, and depending on whether you're a married couple, a single individual, the rate bands differ, but the marginal rate or our top rate of income tax is 40%. On top of income tax, then we have here in Ireland what's termed universal social charge, which is a relatively new tax which was introduced here about 10 years ago as a temporary tax. It's still temporary, and I suspect in the next 20 to 30 years it'll probably still be temporary. And that's on a sliding scale of a range of rates going from 0.05% all the way up to 11%. I suppose just for the purpose of this presentation this morning, I won't go through all of the various rate bands, but suffice to say that if you are earning more than 100,000 euro from non-PAYE income, so in other words, a self-employed individual or investment income, the 11% kicks in once you reach 100,000 euro. We then have pay-related social insurance, PRSI, which is the equivalent of your NIC or national insurance contributions in the UK. And the rates there are 4% for the employee or a self-employed person. And then there's also an employer rate then of currently 11.05%. So if in an employment situation, the employer contributes 11.05, the employee contributes 4. And if you're self-employed, you just pay the 4% yourself. So that's kind of on the, if you like, on the individual, on the personal tax side of things. On corporates then, corporation tax, we have our standard rate for trading activities is 12.5%. There is a slight variation on that for certain property transactions here, or certain property trades here in Ireland that I don't need to go into today, where the rate is actually 25 as opposed to 12.5. But for all other trades, and really for the purpose of today's discussion, it's a 12.5% corporate tax rate for professional services firms. There is also, as I mentioned, the 25% for certain property activities, and the 25% in Ireland also applies to non-trading income. So if a company is in receipt of rental income or other investment income, the Irish tax rate is 25%. In addition, for professional services closed companies, and I'll come back to closed companies in a moment, there is an additional 7.5% surcharge on trading income, where that trading income is not distributed by the company within 18 months of the year end. So if you take a situation where we have a professional services closed company, and again, I'll explain closed company in a second, it will pay 12.5% tax on its profits. And then if those after-tax profits are not distributed out to the shareholders within 18 months, there's an additional 7.5% surcharge applied to the after-tax profits. So it's really, I suppose, an incentive or a disincentive, I suppose, from a revenue perspective to ensure that closed companies distribute their profits out to their shareholders. A closed company, from an Irish perspective, is defined as one which is controlled by 5 or fewer people. And in the case of a company owned by a professional partnership, including a UK partnership, then the closed company, the partners are actually defined as one person. So in other words, if you have a partnership owning an Irish company, it is automatically a closed company and therefore potentially subject to 7.5% surcharge. We have a standard dividend withholding tax here on dividends paid out of Ireland at 25%. However, that doesn't apply in most instances where the dividends are paid to shareholders in another tax treaty jurisdiction, obviously including the UK. So generally speaking, an Irish company paying dividends to a UK shareholder, the dividend withholding tax should be exempt, provided certain applications that are made to revenue. We also, in the professional services sector, there's also a professional services retention tax, and this applies in relation to professional services provided to government bodies, state-owned organizations, and where professional services are provided to those bodies are obliged to withhold 20% of a withholding tax on the payment of the fees to the professional services company. And it's a cash flow thing that you can get a credit. The professional service company can get a credit for the withholding tax, but the withholding tax is applied at source by the relevant government body. Our standard rate of VAT here in Ireland, which includes professional services, is 23%. And finally, then we have a standard capital gains tax rate here of 33%. So as you can see, that's pretty much the full range of taxes. The ones that are relevant, obviously, would be income tax, where you're operating here through an individual or a sole trader or a partnership structure. And that would include obviously USC and PRSI. Corporation tax, where you're operating as a company and potentially the surcharge applies as well. Dividend withholding tax, probably academic between Ireland and the UK. And then obviously professional services withholding tax, which is applied to all professional services here by state bodies. And our standard rate is, say, VAT is 23% on professional services. Okay, if you could move on, Jade, please. So in terms then of the structure options, just flick to the next one, Jade. Thank you. Youth professional services firms established in Ireland. I mean, there's normally one of kind of 5 or variations on, but I'll just kind of stick to these main 5 options. first one would be, and in no particular order, because there's no one size fits all, I suppose, is the first thing to be said. So the first one is just an Irish branch of your existing either UK LLP or partnership, general partnership or company. That's probably the one which is maybe the simplest one to get your head around. The second one is in having a separate Irish general partnership. Would be a bit unusual, but it's still used by some entities. Thirdly, then would be a kind of a variation on the one above, which is a general partnership or an LLP here in Ireland, which I'll mention at the end, with a separate service company. So in other words, a partnership with a service company to one side. The next option then is an Irish limited company. So a straightforward Irish limited or DAC, which are more or less the same thing. They're both Irish limited liability companies. And then finally, and this only applies in the case of legal services, would be an Irish LLP. And there are particular rules about, and it is exclusively for legal services, but is certainly the structure which is most commonly used by Irish legal firms here. Pretty much they're almost all at this stage would be LLPs. Maybe at this stage I might just put over to Louis, because I know there's some, I suppose, background in terms of a UK perspective on those structure options, and then I'll come back maybe and just talk a little bit more detail about each one.
Yeah, thanks, Eddie. I don't know if we can go to the next slide, Jade. I think kind of this is where we spend a lot of our time, Eddie, discussing and working together when we're looking at UK firms setting up in Ireland. And I think just perhaps taking your structures one by one, effectively, I think there's issues that we talk about and consider under each section. I think taking the one by one as you did, we can talk at a high level what those issues might be from our UK perspective and what we consider. I think with the Irish branch of the UK LLP, I think our concerns are having all partners in the Irish personal filing net. And obviously that adds to the administrative burden of the firm. You've got your professional costs for filing everyone in the UK. With the Irish general partnership, I think a lot of firms don't like unlimited liability, as we know, but it depends on the nature of the firm. And you'd also need to consider your valve partners. Some partners are very particular that they don't want to be valve partners. You have a selection of partners who often are valve partners. But also given the fact that where income tax rates and additional charges are higher than the UK tax rates, you need to probably monitor your profits quite carefully that you're repatriating back to the UK via a valve partner, given potential tax leakage there, because I think it can get to a marginal rate of 51% in Ireland compared to 47% in the UK. So you might consider putting more valves in, etc., to spread your profits. In terms of the Irish general partnership or LLP, I think the same issues are as the previous point as the Irish general partnership. Obviously, with the limited liability company, you've got your dual layer of tax, so it becomes a bit more expensive getting your money back to the UK in terms of corporate tax and then dividend taxes. So perhaps a bit more expensive than if you're using a valve partner in another structure. And then finally, I think Irish limited liability partnership we're seeing a lot more use of those, Eddie, in terms of our client base, as you quite rightly mentioned. We're not regulatory advisors, but obviously the regulatory position needs to be considered in terms of who your partners can be in that entity in terms of EU qualified individuals. And again, you need to come back and consider the choice of the valve partners. Perhaps if I can, and I think that's probably it from my side. So back to you, Eddie.
Okay, thanks, Louis. Okay, so the first one to look at then is a bit more detail is the Irish branch of a UK LLP or indeed a UK general partnership, I suppose more less commonly used, or a UK company. So the first thing to say about that is, I suppose, is the Irish branch or permanent establishment will be subject to Irish income tax or corporation tax, depending on whether it's a branch of a corporate or whether it's a branch of an LLP or a partnership. So in the case of an Irish branch of a UK partnership, so the first thing is really to determine from an Irish perspective, the tax status of the overseas partnership. In other words, is it opaque or is it transparent? Now, in most instances where you're talking about, say, in the case of the legal firms, if it's a UK LLP, generally speaking, the Irish revenue authorities will look at that in a similar vein to that of the UK. In other words, they will treat it as being a transparent entity. So if you have an Irish branch of a UK partnership, generally speaking, that would be treated as being a transparent entity for tax purposes in Ireland. In other words, the partners would be subject to tax rather than the branch itself. And as Louis touched upon just in the previous slide there, that in that instance, all of the partners of the UK partnership would be required to file annual Irish income tax returns to reflect their share of the profits from the Irish branch. And unfortunately, unlike the UK, we don't have the provision of a composite return as you do in the UK, where all the parties can effectively, in most instances, just kind of be part of one composite return. We don't have the facility in Ireland, and in Ireland, each individual partner would have to file an individual Irish tax return, pay their individual Irish tax in respect of profits from the Irish branch. So it is quite cumbersome and quite a lot of administration obviously involved as well in filing tax returns, etc. From an Irish perspective, the individual parties would be subject to Irish income tax and USC, as I mentioned in the first slide, at the prevailing rates. The UK resident partners would normally be exempt from Irish PRSI on the basis that they would be spending less than 25% of their time here in Ireland. They would obviously continue to pay your NIC, but generally speaking, UK resident partners wouldn't be required to pay the Irish PRSI. I suppose the final point on that is, and this obviously applies in any kind of cross-border arrangements, I guess, between entities in different jurisdictions, would be to keep an eye, obviously, on transfer pricing limits and regulations around, well, particularly say head office charges. In other words, the UK charging fees or whatever management fees into Ireland, or indeed vice versa, given that the Irish rates in the case of a corporate would be lower than the UK. But there are obviously transfer pricing rules that need to be borne in mind in any cross-border charges. An Irish branch of the UK corporate then is obviously a similar kind of principle. The Irish branch would be required to file, actually that should be a corporate tax return rather than income tax return, to reflect its share of profits from the Irish branch. Irish corporation tax of 12.5% would apply on the branch profits. And again, the transfer pricing rules would need to be looked at very carefully to make sure that there's both revenue authorities are happy with the charges from either side. Interestingly enough, an Irish branch of the UK corporate would not attract the closed company surcharge that I mentioned earlier because it's not a resident. It wouldn't be an Irish resident entity. So the Irish corporation tax for an Irish branch of the UK corporate would generally be just at 12.5% on the branch profits. Louis obviously touched upon getting your profits or repatriating your profits back from Ireland back to the UK, and that obviously would need consideration in terms of withholding tax, etc. Just go on to the next one, Jade, please. Then a general partnership, and as Louis kind of mentioned earlier, that this wouldn't be particularly common, and indeed certainly in Ireland, people try and stay away from general partnerships simply because of the unlimited liability aspects. As I say, legal services now generally mostly operate in Ireland through LLPs, and most other businesses would tend to be incorporated businesses. Even in our own business in the accounting world, we could carry on most of our activities through a limited liability structure. Certain elements of the business, certain types of audits still have to be carried on by an unlimited liability entity, but generally speaking, people try and corporatize. So having said that, in the case of a general partnership, as I said, unlimited liability, the partnership doesn't pay tax on its own income because it's treated as transparent, although the partnership must file an income tax return declaring all of its income and expenses and setting out the allocation between the partners. The partners themselves obviously then pay the income tax individually on their share of the Irish profits, and they pay it, again, as I mentioned, the rates, income tax, USC, and PRSI. The partnership itself obviously is liable for payroll taxes and VAT, but the income tax obviously applies just to the partners. And as Louis mentioned, foreign residents, so for example, UK resident partners in an Irish general partnership will be taxed in Ireland on their share of the partnership income attributable to the Irish operation of the Irish source, and the maximum rate typically would be the 51%, which would be the income tax and the USC, not the PRSI. That's how we get the 51. And the company then would pay 25% tax on its share of profits. Next slide, Jade, thanks. This is a variation then, which is I say would be most commonly used certainly by Irish general partnerships, and that is that running it alongside the partnership is where there will be a separate service company, which may be limited or may be unlimited depending on people's requirements, and that would be established in order to provide the partnership with services such as labour hire, recruitment, clerical administration, HR, facilities, etc. And it would charge partnership for the provision of those services. The service company is owned by the partners. The partnership is a per service fee, typically calculated by sort of a cost plus or a markup on the cost base of the service company, although you can have a fixed charge or some other benchmarking attributes to it. There's no published kind of indicative markup rates, but the normal range for a cost plus in the service company would be somewhere between 5 and 10%, depending on the type of services that are being provided. So from a tax perspective, the partnership would receive a tax deduction for the service charge, which obviously at the marginal rate would be at an effective rate of 55%. That's for the service being paid to the service company. And the service company then would pay, as a company, 12.5% corporation tax on its profits. And the main benefit, I suppose, of having a service company from an Irish perspective is that the service company facilitates the individual partners or directors in making enhanced pension contributions. Under Irish law, the amount of a pension contribution that an individual will get tax relief on is capped. And depending on your age and your income, it's generally in and around 30 to 40,000 euro per annum that an individual can get a tax deduction for a pension contribution. However, with the service company structure, the individual can still make the maximum personal contribution of 30 to 40,000. But in addition, the service company, as the individual's employer, can also make an employer's pension contribution. So it facilitates, to say, individuals being able to put or to enhance their pension fund by having a contribution personally and also from a service company. And that's the main purpose of the service company structure, really, is to facilitate pension planning. If you just click on there, Jade, thanks. The next structure then, which is quite commonly used, is simply to have an Irish company carrying on the business in Ireland. First question that needs to be considered here, I guess, is and this is probably more from the UK perspective rather than an Irish perspective, but would be the residence position. In other words, if the company, albeit would be incorporated in Ireland and carrying on a business in Ireland, is it resident in Ireland for tax purposes? And residence is determined not by the place of incorporation, but generally by the place of management and control. So if you have an Irish company which is established in Ireland, but is managed and controlled in the UK, well, then it will be regarded as being resident in the UK for tax purposes. Irish tax will still be applied in the case of a resident company on the worldwide profits of the company, or in the case of a non-resident company, the Irish tax would just apply to the Irish profits. Now, obviously, if your Irish company is doing nothing else but carrying on the business in Ireland, well, that's kind of a moot point because it's going to be the same profits, whether they're worldwide profits or Irish profits are going to be the same if it doesn't have any other activities. An Irish resident company will also potentially be subject to the 7.5% surcharge. A non-resident Irish company would not be subject to the surcharge. So that's a kind of a key difference purely from an Irish perspective. Obviously, you need to consider the UK piece. So if you have a resident company in Ireland, it will pay 12.5% on its profits and potentially also the 7.5% on undistributed profits. If the company is resident in the UK, well, then the Irish revenue still get their 12.5% on the profits, but there won't be any surcharge. The Irish company will always be liable for payroll taxes and VAT in Ireland. And as I mentioned earlier, generally speaking, there should be no withholding tax on dividends paid by an Irish company to UK resident shareholders, or indeed shareholders resident in any other tax treaty jurisdiction. From the director's point of view then, as an employee or a director, will earn any emoluments or remuneration paid to directors or employees may be subject to Irish payroll taxes where the duties are carried out in Ireland. And Mark will expand a little bit on that later in his presentation on the employment taxes side of things. Next slide, Jay. Thanks. Finally, then, an Irish LLP, and as I mentioned, and Louis did touch upon it as well, this is exclusively for provision of legal services, and it's provided under a separate legislation. The first thing I would say in terms of anybody, certainly in the legal profession who's looking to set up in Ireland, is certainly to look at the LLP structure. The first thing you need to do, I would suggest, is before you even think about the tax piece of it, is to contact the Irish Law Society and just, I suppose, engage with them. They're very open to engagement from firms, and as you can imagine, they've been very busy, certainly since Brexit, and dealing with inquiries, not just in the UK, but from other jurisdictions in terms of lawyers setting up here in Ireland as a EU base. They don't like, what would you call them, maybe brass plate operations, so they do like to see, before they will approve any establishments in Ireland, a kind of a real substance to the Irish office rather than just a brass plate. But certainly the first thing to do if you're from a lawyer is looking at certainly setting up in Ireland is to speak to the Irish Law Society just to determine what the rules and regulations are from a regulatory perspective.
And Eddie, has that kind of brass plate view kind of changed over the recent years? I think a few years back you could potentially
you're absolutely
Ireland.
right. It very much did. I mean, when Brexit, I suppose, reared its ugly head, there was a flurry, as you can imagine, of inquiries, let's say, particularly from London firms looking to maybe set up a branch or do something in Ireland or have a place in business in Ireland. And it was pretty laissez-faire, I think, with Law Society. They basically just collected their fees from registering people as Irish lawyers. But certainly in the last couple of years, they very much kind of tightened up on those kind of operations. And really now we're just looking, as I said before, to authorize proper, if you want to call it, established, boots on the ground in Ireland activities. Now it doesn't have to be any particular scale, but certainly, there will need to be, a real substance to it, and people in Ireland carrying on business in Ireland. So, as I said, most Irish legal firms at this stage do operate as LLPs. It does provide, the big advantage obviously is that it does provide limited liability, and for partners, and personal assets are protected from the negligence of other partners. Partners may still, even as an LLP, partners may still be held liable for liabilities arising from their own acts of fraud, dishonesty, misconduct, or criminality. But generally speaking, it gives you limited liability protection. From a tax perspective, it's the same treatment as an Irish general partnership, i.e., the LLP is tax transparent. So it's the individual partners who pay tax on their share of the profits. So there's no difference from a tax perspective. And indeed, most from an Irish perspective, general partnerships which convert to LLPs is really a non-event from an Irish tax perspective. They keep the same tax number, and nothing changes because the tax treatment is the same. You can also, and again, this would be quite common as well, you can also use the service company structure for your pension arrangements with an LLP in exactly the same manner as you would with a general partnership. I think that pretty much wraps up my slides on it. I know there's a lot of information there to digest. We've given quite a number of options. As I said, there is no one size fits all. I mean, it's really just a function of, I guess, in the first instance, what the structure is in the UK, what sort of business you're going to be running in Ireland, how many people, what the substance of it is, would be the driver for, I guess, the Irish structure. Obviously needs to marry with the UK structure, and hence ourselves and Louis and his team have a lot of interaction together in trying to pick the best option for clients that meet the Irish and the UK tax requirements. At this point, I'm just going to hand you over to my colleague Mark Hines, who's going to take you through some of the employment taxes issues. Thank you.
Okay, thanks, Eddie. My name is Mark Hines. I head up the employment tax team here in BDO Ireland. And I'm just going to touch on the payroll tax obligations and implications of foreign employers sending employees to Ireland, either as informal arrangements such as multi-state or short-term business travellers, and in the more formal secondments. So Jade, if you could just move on to the next slide then. So I suppose the issues we're just going to touch on are whether or not the employer will have a payroll withholding obligation in Ireland, what revenues practice is in this area, the way we can avail of the DTA relief upfront through the payroll process. And then finally, we'll touch on the Special Assignee Relief Programme, which is an INPAT regime in Ireland to attract key executives into the country. So in terms of the payroll withholding obligation, I suppose first and foremost from a legislative perspective, the authorities have the power to impose a payroll obligation if the individual employee is here for as little as 1 day. Now, thankfully, Revenue do take a far more pragmatic approach to that. So, Jade, if you could just move on to the next slide there. So this, I suppose this grid just gives you a snapshot of what the position is, depending on the number of days present in Ireland and depending on the jurisdiction that you're coming from. So I suppose from the get-go, there is no obligation to operate any payroll tax, make any registrations, make any filings whatsoever with Revenue if the individual in question is only going to be here for less than 30 working days in a calendar year. That's the position regardless of the jurisdiction the individual is coming from. It gets a bit more complicated then once you go beyond the 30-day period. If you're coming from a non-DTA country, you're immediately into a payroll obligation once that 30 days is exceeded. And the payroll obligation will apply to all the salary attributable to all Irish workdays, not just the excess over the 30. So I suppose that people on this call are probably more interested in the DTA column. So once you go beyond the 30 days, but less than 60 working days, you can effectively self-assess as to whether or not a payroll obligation will apply in Ireland. And effectively how it operates is that if you assess that the individual will be exempt from Irish income tax under the Dependent Services Article, normally Article 15 of the treaty, then you can basically self-assess that a payroll obligation does not apply. There is no requirement to make any submissions to Revenue. You just need to keep your analysis on file in the event that Revenue do query it. Once you go beyond the 60-day period, you're carrying out the same analysis. You're basically determining, will this individual be exempt from income tax under the relevant article, the Dependent Services Article? But in this case, you actually need to make a submission to Revenue to obtain what's called a PAY dispensation order. Now, if you don't make the application or you don't make it on time, then a payroll obligation will trigger. That doesn't preclude the individual from then subsequently filing an income tax return and getting a refund. But from an employer perspective, a payroll obligation will trigger in the absence of having a PAY dispensation on file. And it's quite a common area where foreign employers get tripped up. I suppose one of the quirks of the system is that in order to obtain a PAY dispensation order, you would have to register as an employer with the Irish tax authorities in order to obtain a ruling from Revenue that you actually don't have to operate payroll taxes. But that's the only, I suppose, quirk in the system. Once you go beyond the 183 days, then a payroll obligation will automatically trigger. And once a payroll obligation does trigger, it's on all Irish workdays. It's not just on the excess over the 30 or over the 60, etc. So in terms of the treaty relief, Jane, if you could just move on to the next slide there.
Just very quickly, just pausing for a quick question, Mark Eddie, at that point.
Yeah.
If you go back to the previous slide, Jade, if that's okay. So at this point, the question from the audience is there a distinction in rules between employee and partners on these days? I assume that there would be, given the fact that employees are subject to payroll and partners self-assessment.
Oh, correct. Yeah, this would be specific to payroll, as opposed to as opposed to the self-employed.
Yeah, perfect.
Absolutely. Yeah, so a separate article. So yeah, on to the next slide there, Jade. So in terms of determining for the 30 to 60 day period, and then subsequently the 60 to 183 day period, what you're effectively looking at is the dependent services article and whether you can meet all four conditions. So the four conditions being that the individual must be resident in a DTA country with Ireland, there must be a genuine foreign office or employment, the remuneration must be paid by an employer who is not a resident of Ireland, and then finally the remuneration is not borne by a permanent establishment which the foreign employer has in Ireland. Now, interestingly, the third condition is normally, like most jurisdictions, and for that matter, the OECD guidelines would consider that condition from the context of whether or not the Irish entity or there is an economic employer in Ireland. However, Ireland is, I suppose, somewhat of an outlier in that from 2020 onwards, Revenue changed their position on this, whereby they only now consider that from the legal employer's perspective. So effectively, it's quite a straightforward condition to be considered now, in that if your employer is a foreign employer and the foreign employer is making that payment of your remuneration to the employee, that condition is usually readily met. There's no requirement to get into who's bearing the burden of the costs, and if the individual is integral to the Irish business, etc., etc. You're simply looking at legal employer as opposed to economic employer. So in reality, when you're determining whether you may have a payroll obligation under the two categories of 30 to 60 work days or 60 to 183, your really main focus is going to be on whether or not the foreign employer has a permanent establishment in Ireland, either an existing one or by virtue of the activities carried out by the individual. So I suppose Eddie was talking about having an Irish branch in Ireland, and a branch in Ireland, and the implications that will have from a business perspective. But obviously, a branch is a permanent establishment. So if you've got individuals coming over to an Irish branch and they exceed the 30 workday period, well, then you're going to have a payroll obligation on all their Irish workdays from the get-go. When filing for a PAY dispensation order, Revenue do require that application to be made within 30 days of the employee first arriving in Ireland. Sometimes that's not always practical, and Revenue will show some leeway depending on the specific circumstances, but you should be aiming for getting the application in within 30 days, if at all possible. So that's a quick snapshot of the payroll obligations that you would have for when sending employees over to Ireland. So I suppose we're just going to, Jade, if you move on to the next slide now, we're just going to touch on the Special Assignee Relief Programme. This was introduced back in 2012, and at the moment it's to run up to the end of 2025, where it tends to be extended by a couple of years, every few years. So the logic behind it was it's effectively a mechanism to attract key talent, key individuals, decision makers into Ireland, with the logic being that if you can base the decision makers in Ireland, well, then you will grow domestic employment on the back of that. The relief itself is pretty straightforward, in that 30% of the individual's total remuneration in excess of 100,000 falls out of the income tax net. Total remuneration, it used to be open-ended. It was reduced down to 1.5 a few years ago, and then subsequently down to 1 million. But still, it has the potential to reduce your Irish effective tax rate by in around 12% year on year. It's a relief that can be availed of for 5 consecutive tax years. And if you qualify for the relief, it also enables your employer to provide you with annual school fees of up to 5,000 per child, tax-free, and 1 return journey home each year, tax-free. In the absence of that, technically they would be taxable benefits. So we'll just move on to the conditions now. There are, next slide there, Jade. So there are numerous conditions that need to be met, and they all need to be met. So the first one is obviously it's the key drivers to attract key executives, decision makers. So there's a minimum base salary requirement of 100,000 that needs to be that the individual needs to be in receipt of. So that's excluding any benefits, any bonuses, etc. It's just base salary. Obviously, the employee will need to be tax resident in Ireland in the year they're claiming SARP. It's open to Irish citizens as well as foreign citizens. The only requirement there is that the individual must have been non-resident in the previous 5 years prior to coming to Ireland. It's also the employee, the relevant employer must be the one driving the decision for the individual to come here. So it must be at their request that you come here for business reasons. It's not open to the employee requesting a move to Ireland for personal reasons or remote working scenarios. As I said, it's to drive domestic employment, so there has to be a business reason behind it. There are a number of pitfalls which I'll talk about in a while, but in the context of these conditions, the 6-month period prior to arriving in Ireland, the individual must have been employed by a relevant employer. A relevant employer, in this case, is a company located in a country which Ireland has a GTA, and they must have carried out all of their work outside of Ireland in that 6-month period. So next slide there, Jade. So then the last 3, the individual must, in the first 12 months after arriving, they must work in Ireland in each of the 12 consecutive months in that first 12-month period. The filing, there's a requirement to file an application with Revenue, whereby Revenue will assess whether or not the SARP will apply. That must be filed with Revenue within a 90-day window. It's a very strict 90-day deadline. And in addition to that, the employee now must have registered with the Irish social welfare authorities and tax authorities, all within that 90-day window. So next slide there, Jade. I'll just talk about those potential pitfalls when it comes to SARP. So while SARP is, it's an attractive benefit if the conditions can be met, and that it reduces the effective rate by, as I said, in around 12%, or for that matter, if the individual has been tax equalised to their home country, it can have quite a significant reduction in the overall cost to the employer of funding the assignees package. So in terms of the pitfalls, as I said, the 90-day filing deadline is an absolute red line for Revenue, and we have had numerous cases where applications have gone in late and they have all been rejected out of hand. So it's not just a case of losing SARP for that year, you lose it for all 5 years if that 90-day filing deadline is missed. The next potential pitfall is, well, the next 2 potential pitfalls are around the 6-month period leading up to coming to Ireland. In some cases, the employment might be transferred to the Irish entity, and we've had scenarios where this has happened within prior to the individual actually arriving in Ireland. Technically, that falls foul of the condition because they weren't employed by a relevant employer in the 6-month period leading up to the transfer. So Revenue concessionally allow a 5-day window where you can basically get the paperwork in place if needs be prior to the transfer into Ireland. The next one is it's quite a difficult one. The 6-month period prior to coming to Ireland requires you to carry out all of your duties outside of Ireland. However, when you're looking at more formal transfers or permanent relocations to Ireland for key decision makers, you tend to find that they will have made a number of business trips to Ireland in that 6-month window. for a number of reasons, in terms of getting to understand the business, understand the team, meeting the team, etc., etc. Again, technically that falls foul of the condition, because all duties haven't been carried out outside of Ireland. Again, revenue allow a very limited exception whereby the individual can work a maximum of 5 days in Ireland in that 6-month window. They will also allow accept brief trips to Ireland for look-see visits, but in terms of work days, you are very much limited to those 5 work days. Anything in excess of that risks you failing to meet the conditions, and therefore SARP will be gone for the full 5 years. And then finally, the last one is the individual's requirement to perform duties in Ireland in each of the 12 consecutive months following arrival. This only applies to the first 12-month period, but where you can fall foul of it is if the individual arrived, we'll say in February of this year, at the end of July, decide to take a 2-week holiday back to the home jurisdiction, and then decide to work remotely for the following 3 weeks before coming back to Ireland, and then arriving in the following month. If that's the case, the individual will not have worked in Ireland in that month, and therefore revenue will view that as not meeting the condition of working for each of the 12 consecutive months following arrival. So when it comes to SARP, it's an attractive benefit to obtain, but it does come with a series of health warnings, and there are numerous pitfalls to be aware of. But that's a very quick snapshot of the payroll obligations for foreign employers.
And Mark, can you just remind us when SARP came in?
It came in 2012.
Okay. And can you apply for any form of certification for SARP, or is it just you make an application on your tax return?
No. You have to make an application within 90 days of the individual first arrival. And if that 90-day deadline is missed, well, then SARP is gone. And every firm in Ireland has a number of cases they can point to where that 90 days was missed and has been rejected by revenue. There is no leeway.
Okay. Sounds quite strict.
Very, yeah. You'll get a nice letter from revenue empathising with you, but you still won't be getting SARP. So that's it for me. So I suppose Louis will just open it up to any questions we may have.
Thanks very much, and thank you both, Mark and Eddie. I guess Eddie, one for you is we get quite a lot of questions around partners of UK partnerships spending time in Ireland and associated risks around permanent establishment. From my understanding, it's, strictly speaking, a permanent establishment can be created from a partner conducting business in day one. Have you got any other comments or thoughts on this? Because obviously lots of partnerships will have partners going over from time to time, and I think there's a pragmatic position as well as what the strict position is, but it's just interesting to get your thoughts.
Yeah, it is. I mean, that's what it's always been a kind of a grey area or a very subjective area of what constitutes a PE, where you've got kind of intermittent visits. I guess you step back to first principles. In other words, if the partner, I suppose it's a distinction between, say, doing business in Ireland and doing business with Ireland. So obviously, if you're doing business in Ireland, would be things like obviously having, well, on one extreme, an office or a fixed place of business here or a base. But if you don't have that, and it's just literally, an individual, say, coming over from London to meet up with potential clients or to do a bit of sales and marketing or whatever it might be, I think provided that they're not, concluding contracts in Ireland, that they don't have a fixed place of business in Ireland, there's no kind of, unlike an employee situation, there's no kind of minimum number of days that you can or cannot spend here. So I think it would be more just that you're seen to be not doing business in Ireland, but you're doing business with Irish clients. So provided you don't have a fixed place of business here, provided you're not over here, I suppose, concluding contracts or having letters of engagement or whatever in Ireland, I think it's you probably should be on the right side of it. And you have more of a representative office kind of feature rather than having a permanent establishment.
No, that's useful. Thank you. As we know, this is a grey area in lots of countries, and there's no hard and fast answer or rule.
There's not. No, I mean, there's not. As you know, there's no definition. I mean, the treaties obviously give you, you know, some criteria as to what constitutes a PE, but you know, most of the treaties were written, or the text is about 50 years old, and you know, the concept of doing business is very, very different now than it was back then in terms of physical meetings and all that kind of thing. Now, obviously, the OECD are looking at obviously refining the definition of PE. But you're still back to, I think, the distinction between doing business with and doing business in a country.
Perfect, thank you. Another question from the audience. If an Irish national living in the UK spends holidays in Ireland, does this count towards the workday count?
No, it's work days. It would count towards the 183 day in terms of determining their residence, but it wouldn't count towards a workday. Now, I suppose just to caveat that, if they were separately carrying on work days in Ireland and they were separately, and then in addition to that holidaying year, I know in the UK you have a more defined, a more relaxed view in terms of what a workday is. I think you can carry out a certain amount of hours before it's considered a workday. But in Ireland, a workday is considered a day where you carry out any work. So if they were holidaying here and arguably doing even an hour's work, well, then technically that is a workday.
Yeah, okay, understood. Another question, just for confirmation, I think as for employees where we had kind of your limits for payroll thresholds, there's no defined minimum days for partners, and I think we kind of picked that with you, Eddie, in terms of establishment risk. So really, no, there isn't in terms of a strict definition. It's a grey area that will need to be looked on by circumstance, I think is the answer we gleaned from that.
Yeah.
And I guess next on your agenda probably is you have UK Irish resident partners who are partners of a UK partnership, and obviously we've got basis period reform coming in 23-24, so you'll be considering, I guess, at your end how to treat your double tax relief in Ireland for UK taxes, given the change in our basis period coming up.
Yeah, sorry, this is Irish resident partners in a UK partnership?
Correct, yeah.
Yeah, I mean, it's unfortunately, we have different tax years, which doesn't help. We're obviously 31 December. You guys are 5th of April. You know, normally the principle is still the same. You know, you get double tax relief for the taxation of the same income in both jurisdictions. So I guess it's a matter of you know, agreeing what the same income is, and then what tax has actually been paid in the relevant, in Ireland and in the UK on that income. And the treaty obviously just applies to do a credit. So there'll be a bit of computational gymnastics, probably, particularly in
I would assume so.
Transition from, you know, what currently is the case to your, you know, actual 5th of April basis, which is next year. I think it's
March 24. Yeah. Another question: what's the position, residency, etc., if an individual lives in Northern Ireland but travels to the Republic of Ireland to work as an employee?
It's two separate jurisdictions. So if they're working in Ireland, working in the Republic of Ireland, there will be a payroll obligation for the employee, for the employer in Ireland.
Yeah.
Now, and then separately, they would need to then file a UK tax return disclosing that income. But I would imagine there will be no additional taxes to pay, because I think the Irish effective tax rate is probably higher than the UK effective tax rate. But so there should be no. The individual will have presumably a higher effective tax rate, but would have no additional taxes, I would imagine, in the UK.
I think that's probably right.
It could obviously be technically dual residents, you know, residents in Ireland by virtue of our days count, and obviously resident in the UK by virtue of the UK days count, and then you're into the tiebreakers.
If living in the UK or in the north, I would imagine
it defaults in the UK most time. Yeah.
I think that's it from the questions today. There are quite a few there, so thank you both, Eddie and Mark, for picking those up, and thank you everyone for joining today. So that kind of brings us to the end of the webinar. You can have 5 minutes back of your day. We will circulate our slides and recording of this webinar in due course. Can't believe I'm saying this already, but our new 2024 series begins in February, and we'll circulate our agenda for next year's topics shortly, because that's all been organised. And then, if I don't speak to you before, wishing everyone a lovely festive break and a happy new year. So thank you, everyone.